This is Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
It's the last show of the month, and as we do at the end of most months, it's time for our Frequently Asked Questions show here on Debt Free in 30. On most Frequently Asked Questions shows, we've got a list of 5 or 10 questions. Today, the list is much shorter. We'll probably only get to 2 questions, but they are 2 important questions. The first question is one that's been the subject of lots of discussion over on the Hoyes Michaelis Facebook page. And as a reminder, if you're on Facebook, you can find our page at facebook.com/310plan, which also happens to be our phone number, or you can go to Facebook and search for Hoyes Michaelis or 310plan. So the first question we're going to answer today is, can I just walk away from my debts? What would happen if you owed money on a credit card or bank loan and you just stopped paying it? In many cases, if you are deep in debt, a consumer proposal or a bankruptcy is the necessary solution. But what would happen if you just stopped paying? You didn't file a bankruptcy or a consumer proposal. You just stopped paying. That's today's first question. So to answer it, I'm joined by my Hoyes Michaelis partner and co-founder, Ted Michaelis. So Ted, can I just stop paying? What would happen if I just walked away from my debts? What's the process?
Well, let's break this down and talk about different types of debts. So one of the things you mentioned was credit cards. That's a pretty common problem for people to have. So can you walk away from your credit card debt? Maybe. The bank has got to decide, is it worth pursuing you? So what do they know about you? Have you got employment? Have you got money on deposit with them? Are you a good candidate for them to sue? So if they decide that they really want their money back and you're not cooperating, they could take it to court. Or the bank could decide that, you know what, you're a bad candidate for a lawsuit. You haven't got enough that it's worth pursuing you, and they'll just let you get away with it. The problem is you just don't know which one of those you're going to be.
So if I'm a bank, I got 3 choices then. I can just say, forget it, which of course banks don't like to do because they don't make a lot of money if they just stop collecting debts. They could continue pursuing you through a collection agency, or they could take you to court. So tell me about the whole collection agency process then. If I have always paid my credit card and now I miss one payment, they're not taking me to court.
Right.
What's the process when I miss that first payment?
Well, so when you miss one payment or you're late with a payment, you're probably still dealing with the bank or whatever the credit grantor is themselves. And in most cases, you get a polite reminder next month saying, we noticed you didn't pay last month. If you've made a payment by now, ignore this notice. Otherwise, you owe double this month. That's not too pushy. It's just their way of saying you got to catch up what you owe us. If you've made a habit of this, then instead of getting that polite reminder, you might get a phone call or a letter that specifically says, you know what, you're behind. American credit cards are much more aggressive about that than Canadian ones, by the way. So let's say you've missed the month's payment, you've got this friendly reminder, and the second month comes around and you still don't pay them. So the bank will probably still deal with you themselves for that second month. So again, now if you didn't get a phone call before, you probably get one now. You get a less friendly reminder, or you get a letter that says, you're 2 months in arrears and we need you to deal with us, contact our offices. It's the third month when things get interesting. The third month is when the bank has to decide, are we going to send this out to a collection agency? And this is all about psychology. It's bad for business for the bank to be yelling at you themselves. They want their money, but they don't want to have a bad public impression. A big bad bank is beating up on Jane Doe, the single mom who can't pay her credit card bill. So they send it out to a third party. The third party's job is to collect, and they get paid a commission. Now, the law says you're supposed to receive a letter or notification from the credit card company telling you they've assigned it before you have any obligation to talk to a collection agency. So in 9 times out of 10, nobody ever receives that notice, or they receive it after the collection agency called. So if it were me, I tend to ignore those. If you haven't got a notice telling you who it is that's calling you, why would you talk to somebody on the phone, particularly about your debts?
So, and that's a practical tip there then, obviously. If you're getting a call from a collection agency that you've never gotten a call from before, the first question should be, who are you collecting for? Send me a letter explaining who you're collecting for, what I owe, what the story is. Because you're right, that's the law, certainly here in Ontario. They have to send you written notice before they do that. So,
well, particularly in this day and age with identity theft and all that. I mean, I live in Guelph, and lately we've had a scam on our phone systems. Once or twice a day, there's a message on my machine saying, the federal government, you owe the federal government agent money, your taxes are in arrears, we're going to initiate legal action, you got to call this number now. Well, the federal government doesn't leave messages like that.
No, and you're right. They're getting very creative because with all the fancy phone systems now, they can mask their phone number. They can make it look like it's coming from a 613 exchange, which is Ottawa, and that's where the federal government is, and so it looks legit. So as a starting point, yes, get them to send you a letter so that you know. So
now we're back to the collection agency.
So we're back to the collection agency then.
All right. So the collection agency is going to try and pursue you for a couple of months. Then they have to decide, do they threaten legal action? And if they threaten it, do they actually go through with it? Or do they just send the credit card debt back to whoever your lender is and let them try to deal with you again? Let's say that they've decided that you're a good candidate for a lawsuit. And we can talk about what makes you a good candidate to be sued. And they decide that they're going to do something. If the debt's under $25,000 in Ontario, they can take it to small claims court. Small claims court is a pretty simple system. The person wanting to sue you goes to the courthouse, fills out a statement of claim. The courthouse mails you the notice, and you've got 21 days to respond to it by saying whether or not you want to argue or dispute the fact that the amount that's being claimed. If you don't respond, the person suing you gets what's known as a default judgment. A judge basically says, okay, the debt must be real because you didn't argue about it. Then the next thing they're going to do is apply for a writ of seizure or execution. This lets them garnish your wages, freeze your bank account. In some cases, I suppose they can register something with the sheriff, which effectively puts a lien on your house and your other possessions. I mean, it's complicated stuff, and it's pretty intense.
And it doesn't happen a whole lot in the overall grand scheme of things. And there are relatively few people who actually get sued out of the total number of people who owe money. And the vast majority of those lawsuits would result in, like you said, a default judgment. I don't show up in court because what am I going to say? The purpose of court is not to figure out how much you should pay. It's to figure out, do you owe the money or not? It's really that simple, isn't it?
That's right. I mean, the first responsibility of the court is that the person who's trying to sue you has to establish that you actually owe the money. Now, what you said is correct. Most people don't respond to these notices, and so a default judgment kicks in. But if you were to ask a lawyer or anyone associated with the court just how many cases they actually see relative to how much credit card debt is out there, it's an infinitesimally small number. It's one of those things that it's used as a threat to scare the bejesus out of you, but it isn't often followed through on.
And that's a key point. It's very rare, comparatively speaking, that someone actually gets sued. So we're answering the question, can I just walk away from my debts? And you're saying, well, you know what? It's relatively rare that someone is actually going to sue you for those debts. So under what circumstances is a bank not going to bother suing you? That's obviously the common response. When does that happen?
Well, so the most obvious instance is when they can't find you. So if you've got a relatively small debt on a credit card and you're difficult to get a hold of, so you've moved once or twice because your circumstances aren't great, so you're not getting these notices anyway. The bank, you don't bank with the bank anymore, so your paycheck doesn't go there. They don't know if you've got any money. They know in the past that your income wasn't great. I mean, these are all things that suggest it's not worth spending money on a lawyer to try and sue you. It's good money after bad.
And as a result, they won't do it. So obviously not having wages is going to make a big difference. What's the point in suing someone if you can't garnish their wages?
Right.
So let's go through some of the different types of debt now. So you addressed credit cards right off the bat. That's a fairly simple one to understand. And the process you described is what is going to happen with credit cards.
Yep.
What about payday loans?
I knew you were going to bring this
Well,
up.
I always got to needle you there with the whole
Push
payday
my
loan
buttons.
thing. So.
All right, so payday loans are a funny animal unto themselves because usually when you go and take a payday loan out, you give them a void check or access to your bank account. So if you don't go in and make your payday loan payment, they just take it. Now, of course, you could stop that by putting a stop payment on the account or closing the account. And quite frankly, once you start dealing with a payday loan company, if you're able to break the cycle, that's great, but don't ever give them one of your void checks. Don't ever give them access to a bank account where your pay actually goes into. These guys are notorious for trying to take your payment today. If it doesn't go, well, they'll try again tomorrow. And every time they try to take a payment, you get hit for a service fee. So,
well, and we've talked a lot about payday loans this month. I've had a couple of different guests on to talk about them, and so you can go to our website at hoys.com and search for payday loans, and you can see entire episodes, and we've got more coming up in the future. So that's certainly a big topic. But your point is, You can't just say to the when you get the payday loan, if you give them a void check or access to your bank account and they say, well, if you don't come in on Friday to pay it off, we're taking the money out of your account, you can't just walk away from it if you haven't also put a stop payment on, or if there's
you have to do something.
You got to do something. Some action is required. So what about income taxes that I owe? Can I just forget about that?
So a lot of people think they can forget about income taxes, but you've got to remember that the federal government has a very long reach. They're not required to take you to court in order to seize a bank account or to garnish your wages. They simply send out something called a demand to pay or a notice to pay. And they won't tell you that they're doing it. It'll go straight to your employer or straight to your bank. And after the money's taken, you'll find out who did it. So if you've got a debt with the federal government, I wouldn't play around with that one. It's not the same as a credit card where they get to decide whether or not they're going to sue you. It's not the same as a payday loan. The federal government has the tools to take their money. And you know what I found in the past? They're more likely to be aggressive with small debts, people that owe them a few $1,000s, than with the people that owe them hundreds of thousands of dollars. It makes no sense to me, but I guess it's because it's easier to pick on somebody getting a paycheck than it is somebody running their own business and hiding money from them.
Yeah, and I guess the guy who's the average working guy doesn't have access to the fancy lawyers and accountants and whatever to protect themselves.
That's true, too.
Now, the other element we haven't touched on is the Limitations Act of Ontario.
Yep.
Which says, in layman's terms, what does it say?
So the Limitations Act says if you haven't confirmed the existence of a debt in 2 years, and legal action hasn't been commenced in that 2 years, you now have a defense in court to say that effectively you don't believe the debt is real anymore.
And in real simple terms, if I haven't made a payment in 2 years on that debt, then if they were to take me to court and sue me and try to garnish my wages, I could go to court and say, hey, judge, it's been more than 2 years, and they wouldn't be able to get their judgment, all else being equal. Now, does that apply to income taxes?
It does not apply to income taxes.
It does not. So you can walk away from some debts, and if it's been more than 2 years, it's highly unlikely they're going to be able to take you to court and sue you. But income taxes are not subject to those rules. So even if you owe taxes from 10 years ago and you start working and start generating tax refunds, they're going to keep them. And obviously, Canada Revenue Agency has the power to freeze bank accounts and do other nasty things. So walking away from taxes is generally not a good idea.
Right.
We've been talking up to this point about unsecured debt.
Right.
Tell me about secured debt. So first of all, what does secured debt mean? Okay,
so a secured loan or secured debt is one that you've pledged. You've said that if I don't pay you, you have the right to come and take something from me. The most common examples: car loan, car lease, or a mortgage on your house. So with a car loan, you basically say, if I don't make my loan payments, they've got the right to come and take your car. And
so that's pretty cut and dry.
It is. And they're more likely to do that than the credit card where you don't pay it, because the credit card, their only choice is hound you or take you to court. With a car loan, okay, well, I can come take your car. And for most people, the car has enough value that you need it to get to work, you need it to get the kids to soccer, you've got to have a car. So you find a way to make the payment. So it's a much bigger threat they've got over you.
And so walking away from a car loan debt means your car is going to be gone. It's pretty much that simple. Unless, I guess, it's a very old car that has no value and it's not worth it for them to repossess. But in most cases, that's an obvious answer. So a secured debt is a debt that is attached to something.
Right.
A credit card isn't secured. It's not attached to anything. Income taxes, in most cases, aren't attached to anything. Payday loans, I guess, are attached to your wages. But
we should be careful with the tax because they've got some special rights because, again, we're talking about the federal government. So when a credit card sues you, they get a writ of seizure, a writ of execution that lets them garnish your wages. The court's given them some rights. They still can't come and take your stuff from you. The tax department, if you owe income taxes and the tax department puts a lien on your house, it serves like a mortgage on your house. So it's not like a judgment that there are ways to get around. That's a secured debt, just like your mortgage to the bank, and it's got to be paid, or the government has the right to take your house.
And they don't have to go to court to do that.
That's right. Well, they go to internal tax court, but as far as the average person is concerned, they don't have to do it. They just send a demand.
They push some buttons on the computer. So the final category then is mortgages. And again, I think the answer on this one's pretty obvious. So can I just stop paying my mortgage and everything will be great?
Yeah, only if you want them to leave your house. Now, effectively, what they're going to do is decide, do they initiate power of sale, which is just a legal procedure where they give you 35 days to bring your mortgage current. If you don't bring it current in that time, they've got the right to show up with a sheriff, knock on your door and say you've got to be out in 24 hours. And as unpleasant as all this sounds, they don't actually want to throw you out of your house. That's not how they make any money. But if they go to the point of a power of sale, you should be looking at moving.
Yeah, because the mortgage company isn't going to just walk away from hundreds of thousands of dollars. They obviously want their money. So let's wrap this up then with an overall comment then. So what's your advice? How do you know if you should just walk away from your debts or try to pay them, or should you take some more tangible action like filing a consumer proposal or a bankruptcy?
Well, so as coarse as this may sound, the less you have, the less likely you are to be subject to some sort of legal action. So if you're a person that's living on very modest means, maybe you're on government assistance or a pension now, you're not a good candidate to be sued. There's not a lot of practical reason to do so. If you've got a good paying job, regular income, money in a savings account, or assets that are worth a fair bit, then you are a much better candidate and more likely that someone is going to take action against you. So the more you have, the less likely you can just walk away from something.
Excellent. We'll expand on that a bit in the Let's Get Started segment, but I said I wanted to get to 2 questions, so we're kind of burning through the clock here on the first one, but I think that was good stuff. So the second question I want to answer today in the last sort of 4 or 5 minutes in this segment is, what are the chances my consumer proposal will be accepted? So we've just talked about one of the solutions when you are being pursued, your wages are about to be garnished, you can file a consumer proposal. So give us the 20-second overview. What is a consumer proposal?
Right. So a consumer proposal is an arrangement to repay a portion of what you owe. So as an example, let's say you owe $30,000 to all your unsecured creditors. You can't afford to pay that back, but maybe you can afford to pay back $10,000. And so you make a payment plan to pay that amount of money over a period of time, 1, 2, 3, 4, maybe 5 years. You're automatically thinking, well, why would anybody agree to accept less money? Well, a proposal is designed to be an alternative to bankruptcy. So often in a bankruptcy, the creditors get very little money. In a proposal, you're voluntarily saying, I'm going to pay you some of what I owe. Something is always better than nothing, which is why they make sense.
And so the creditors, which is the people I owe money to, have to vote on this. How does the voting work?
So it's pretty simple. Every dollar you owe is a vote, and we need half the dollars to actually accept the deal. So again, let's use that $30,000 example. If $15,001 or $15,000.01 were to agree to the terms of the deal, it'd be approved.
So more than half have to say yes.
That's right. A simple majority of dollars, not creditors. And that's important because if you owe to 6 different people, but one company is more than half the debt, then it really only matters what the one company says.
Yeah, in that case, one person out of 6 is going to decide.
That's right.
So okay, you go through the analysis and decide, yes, I should file a consumer proposal. So the person is sitting in front of you and says, okay, Ted, so what do you recommend? And you say, well, I think, $300 a month for 5 years is a good thing. And what are the chances then that the creditors are going to accept my proposal? So you already hit on the first thing that they look at, which is comparing it to bankruptcy.
It's got to be a better deal than a bankruptcy. Why would anybody agree to take less money than they're going to get if you were bankrupt, which is a very rules-oriented project? You know exactly what you got to pay in a bankruptcy.
But aren't they going to get nothing in a bankruptcy?
It depends on your situation. So there are cases where you actually have to pay money into a bankruptcy. If you have equity in your home, if you have savings, if you make more than the government guidelines for families of your size. It gets complicated, and I don't think we can get into it here, but bankruptcy does cost you something.
It's based on your income and the assets you have.
Right.
So, and I'll put some links in the show notes to the concept of surplus income, which is what you're talking about.
Right.
Based on your income, you have to pay more. So if in a bankruptcy, it's likely I'm going to have to pay $3,000 because of my assets, my income, whatever. Right. The proposal is going to have to be more than $3,000, or else why would the creditors accept it?
That's right. And there's a second complicating factor. Most of the Canadian credit grantors, so the banks, the credit card companies, the loan companies, have all said that they want a minimum return to accept a proposal. So they won't it doesn't just have to be better than a bankruptcy. It needs to be about a third of what you owe. It's possible to get deals accepted for less than that, but the standard response or standard request that all of these lenders have told us they want is about a third of the debt. So again, if you owe $30,000, you're going to ask you to pay back 10.
Yeah, and when you come in to see us, obviously we can look at the specific creditors you've got. There are some that are more likely to accept 20 cents on the dollar.
That's right.
Each case is different. But you're right. If a bankruptcy is going to generate 1 cent on the dollar for them, it's unlikely they're going to accept 2 cents a dollar in the proposal, even though it's twice as much. It's just
not worth the trouble.
It's not worth the trouble. So one of the other things they look at is prior activity. What does that mean?
And so what they want to know is, how have you been using your credit? So did you deliberately run the balances up in the 3 or 4 months before you came in to file? That suggests that maybe this was a planned activity and they might ask for more money to be returned. Or are you using it in an unusual way? So traditionally you use it to buy gas and groceries and small expenses. But 2 months ago, you took a trip overseas and you put $10,000 on your credit card you wouldn't normally do. Or you repaired the engine in your car. Something unusual or out of the way. Anything like that causes them to take a look and say, well, okay, was there something deliberate done here? Do we need to ask for a little bit more?
And again, that's something we could advise you on. They also look at your expenses every month.
Yeah, it's kind of a gray area. So the government has established guidelines for how much they think a family of different sizes needs to live on. And so within that number, this is what they expect you to spend on rent. This is what they expect you to spend on groceries. This is what they expect you to spend on gas and insurance. And they see enough of these things that if something is unusually high, they'll notice it. So for instance, a family of 3 might spend anywhere between $700 to $1,000 a month on groceries. Well, if your family of 3 is spending $2,000 on groceries, they might wonder why. And there could be very valid reasons for it. Nobody's saying that you can't spend your money the way you want to, but they're going to look to see, are you doing something out of the norm or something that perhaps they could say, if you cut back on that, you could afford to pay us a little more.
Yeah, if you've got a special diet requirements or something, that may be a reason, and in which case that would be explained to the creditors. I guess the final criteria they look at is the overall viability of the proposal. Do you have a job that's going to allow you to continue making the payments, that sort of thing. So there's a number of different factors that go into it. I guess the closing comment is, well, when you come in and see us, we'll look at your situation and figure out what it's going to take to make it work in your situation. That's really the key. We're going to get into a little bit more detail in the Let's Get Started segment and all of that, but for now we're going to take a quick break and we'll be back with the next segment. You're listening to Debt Free in 30.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. That's our show for today. So to find out more about walking away from your debts or how you can evaluate whether or not your consumer proposal will be accepted, please go to our website at hoyes.com. That's HOYES.com for full show notes and links to everything we discussed today. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.